beta is one of the fastest growing categories of the industry today. You can hardly open a newspaper without reading a headline about it. But what is smart beta? Well, let's ask Google. What is smart beta? There's 71 million search results, but the #1 result is from the Financial Times, and it says, smart beta is a rather elusive concept in modern finance. Is smart beta really elusive? Well, it is to some, and that's why we're here today, to try to talk about the basics of smart beta and dispel some of the confusion. Smart beta seeks to enhance returns, improve diversification, and reduce risk for investors. It's really a combination of what we think of as active and passive investing. It's active in that it aims to outperform a cap-weighted index after taking into consideration risk, return, and cost. But it's passive in that implementation is transparent and based on preset rules. Ideally, those rules are objective enough that you could write them down and give them to somebody else to implement. It often comes in the form of an ETF or an index fund, and smart beta strategies capture many of the themes that have historically been present in traditional active strategies, but usually at a much lower fee. How does smart beta do that? Well, to answer that question, we have to understand factors. Factors are investment characteristics that help explain the risk and return behavior of a security. For example, stocks in the same industry tend to move together, or bonds with a similar maturity would tend to move together. You might think of it as the DNA of a stock or a bond. So just like your DNA might govern your stubborn streak or the color of your eyes, a stock's DNA, its factors, help explain a lot about its behavior. Now, some but not all factors have historically had a positive and persistent return over the long term, and those are the ones that we're most interested in. Smart beta ideas are also well understood by the marketplace. Let's look at value, and I'm going to ask Google. So the definition of value from the Webster's Dictionary is something that can be bought at a low or a fair price. And put in an investment context, what that means is that less expensive securities have historically outperformed their more expensive peers. So over the long term, investors are rewarded for holding those lower profile, potentially riskier names. So smart beta strategies try to target those ideas that are value creating, well understood, persistent, and diversifying over time. Now, many of these concepts are not new. Ideas like value or quality have long been part of the stock selection framework for active managers. But what is new is the idea that we can capture them with consistency and inexpensively in a passively oriented portfolio. And that is a pretty powerful idea. So there you have it, smart beta. It's a smart way of thinking about investing beyond traditional active and passive.